Newark Pension Board to order. I'd like to ask to approve the minutes of the meeting from 3:10. I do have one addition myself, and that's that Charlie was in attendance. He was in attendance via the Norwalk system. So if he could be added to that. Aside from that, I found the minutes fine. Are there any other individuals or do you have any changes or for the minutes? If not, is there a motion to accept?
I'll motion to accept.
I guess, Joe, are you around? I'll second the motion. All in favor?
Aye.
Opposed? No, passes unanimous. Thank you very much. Are there any public comments? Would anybody from the public like to speak? If not, we're going to move on to a discussion for the pension eligibility via an affidavit. That's with Ray. If you'd like to speak now, Ray, perfect.
Yeah. So thank you very much for rearranging the order here, Frank. So what Jerry and I wanted to just lay out for you guys tonight was an overture that Jerry made to me about, it's been a while since we did an audit on the pension recipients. So we are working on putting together a simple affidavit to send out to all the pension recipients in the DB plan sometime this summer. That will ask them to confirm that they're still alive, if they're the retiree, or they're the designated beneficiary, that they're still alive. It's a pretty simple process. It's just one that we haven't done in at least 5 years. So we thought it was appropriate to this summer do an audit and affirmation from everyone who's receiving the benefits that they indeed are the designated recipients, beneficiaries of the pension benefit, just so we nail that down. We acknowledge up front that it will be a drawn out process because we will send out the affidavits and we'll get 70% of them back in, and then we'll send out another round. We'll get another 20% back in. And then 6 months later, there'll still be 15 or 20 people that never responded, and we'll work through the issues with them. But we just wanted to let you know that we thought it was time to send out an affidavit to audit and to ensure that the pension monies are being received by the people they're supposed to be received by, and that it will be a process that when we start it out, when we drop those things in the mail, we'll make sure you all know that we're initiating the process.
And could we just, if you, maybe if you provide the board with just a copy of that form letter?
Sure. I think the legal department returned it to us. I think Jerry may have made final corrections to it. So I'll send it to you tomorrow. If not, as soon as we get those, I'll mail it out to everybody.
Excellent, thank you. Does anybody have any questions?
Ray, this is something you've done in the past?
We haven't done it in the 4 years and 2 weeks I've been here. Jerry, do you recall when we may have done this last?
It was done prior to my, can everybody hear me?
Yes.
Yes.
Okay. Yeah, it was done when Jim Hazelkamp was still the director of HR, and that preceded my joining the city. So it was prior to 2015. That was the last time that, and maybe the only time that such an affidavit was requested.
Yeah, Hazelkamp probably left around 12 or 13. So it was around then the last time was done. So it's time to do another affirmation that the people who are getting the money, the pension money, are the people who should be getting it.
Ray, have you looked into whether it's feasible to do anything, in terms of searching Social Security databases, matching them up with deaths and that sort of thing?
I don't think we have. Jerry?
No, we don't have access to Social Security data.
I just want to say that I do have access to the Social Security data. So what I could do is get a list of the retirees. I just need their Social Security number and their first and last name. and then I dump it in, and in a few days I'll get a report. The only thing that I could confirm is if the Social Security match or if the retiree are deceased.
Right. Okay. All right. Well, that's one element of doing this.
I can do that for you tonight.
Okay. Great.
And yet, if there's no other questions, I have one more question for Ray, and that is, you just told us it's 4 years and 2 weeks. You count to 5 years to get your pension?
Well, as a matter of
Okay.
fact, I'm not in the DB plan. I'm in the 401A plan, and I
Okay.
vested already in it.
Okay,
you're a
well,
lifer.
I'm happy to hear that. So that means you'll be here for a long time.
Listen, I vested in the pension in my former employer, and
What?
I did that. I did that with 30 years and 1 month.
Great, terrific. Jerry, would you like to discuss the pensions, please?
I'd be happy to. We have two applications to submit this evening. The first one is on behalf of Faith Ippolito with the Board of Education. She is age 70, so hers is a regular pension. She elected option 3. Her monthly pension is $815.89, annualized to $9,790.68. And the second one is on behalf of Jimmy Penn, also with the Board of Education, a custodian. He is 63, so his is also a regular pension. He elected the standard form of payment. His monthly benefit is $608.41, annualized to $7,300.92.
Jerry, I do have a question on the Jimmy Penn. My understanding was a regular pension, you needed 10 years, and he is only 7.
62 and 5 years.
Oh, okay, that's right, okay.
Yeah, 10 years would be at age
There is-
55.
I do believe that there was one place where he checked early retirement and one place where
Let
he
me-
checked.
Let me see, I've got his application in front of me, yeah.
You did check early retirement.
Yes, he checked early retirement. So, and I didn't know whether that was going to, which way it was done for
Actually,
calculation.
I mistakenly checked that box when I prepared the form for him. It should be a normal. What I will do is I will update the declaration of retirement, and I will send a revised page 1 and 2 to the members of the board just for their records.
The only other thing, I don't think it makes a difference. Under the beneficiary, under percentage, you wrote down half. Does that matter?
No, it does not.
As opposed to 50%? No, okay.
No.
There is no more discussion on the pensions. Is there a motion to accept the pensions?
Move
Approve
to
the
accept
pensions?
the pensions with Jerry's
to approve it?
understanding of replacing the 2 of those pages, updating those pages.
I'll second the motion.
All in favor?
Aye.
Aye. Opposed? No, passes unanimous. Thank you. Brett, do you want to introduce Artisan?
Sure, happy to, Frank. So we have Jamie Sanderson from Artisan on the line here. He might be a familiar face to many of you. So Artisan has been Norwalk's international growth manager since 2014. Certainly a team and a process that Callan continues to have conviction in. And Jamie's going to provide an update on the firm and team and walk us through their investment process as well as a performance review. So Jamie, if you could keep it to about 35 minutes, including questions, that would be great. And happy to assist with any questions along the way.
Great. Thanks, Brett. Well, nice to see you all, and thanks again for inviting me to present and to update. I'll keep the remarks on the firm and the team of the process relatively short, and feel free to ask for any elaboration that would be helpful. In the book that we sent through, the first page 2 is just a little bit of background on the firm. We're kind of like a multi-boutique, and the team that I work for, Mark Yockey's team, which you're invested in, is now the oldest team at the firm in terms of the ongoing involvement of the original PM. We were Artisan's first foray into international investing. Mark joined in 95, about a year after the firm was created, and he's been running the international strategy ever since. Assets under management across the whole firm were about 160 billion at the end of last year. We evolved from being a regular partnership, a private partnership in 2013. We're a listed company now, but employees still own a chunk of the firm. Roughly close to 20% of the equity is in the hands of the existing employee partners. What else? All we do is look after other people's money. Most of the strategies under the Artisan umbrella are equity long only. We do have a team that runs credit, and we've got two teams that have long short strategies as well. Our team is focused predominantly on international equity. We also have a global equity strategy. So, we've always known and researched the US-based companies. We now have a strategy that we can invest in them too. But of the 25 billion that our team manages, about 22 is invested in the same strategy that you're invested in. And then we have 3 in the global equity strategy, and they're pretty synergistic. I think it's important to know what's going on with the US companies to do the best possible job on the non-US companies. You've really got to understand the full context. So we think the two sit quite comfortably together. In terms of the team, there is periodic change in our rank of analysts. In terms of the portfolio managers on page 5, no change there. I mean, Mark, like I said, has been there since inception. Inevitably and understandably, we get questions from time to time, is Mark going to retire? Mark is in his early to mid 60s. He loves what he does. I was in the New York office today. He was leading the charge in the research meeting. I would even say this in his earshot. I think he'll be carried out in the box. Mark really enjoys the business of investing. He's done it a long time. He's been successful, and I don't think he's doing this to pay the grocery bills anymore. He does it because he loves it, and he's a big investor in the strategy. He is supported, though, by 2 experienced co-PMs. So Charles Hamker has been working with Mark since 2000, and then Andrew Reddick since 2005. So we've got a lot of continuity, and we've enjoyed, stability at the top there. So if anything were to happen to Mark, the other 2 PMs would step in fully to take the portfolio forward. The analysts, these analysts are all dedicated to this strategy. Each team as Artisan is, as I kind of alluded to earlier, can be thought of as a mini boutique as its own entity. We don't have centralized research, so everybody on this page works exclusively on the 2 strategies I mentioned to you. They're all buying into the same philosophy and process, which I'll spend a couple of moments on in a minute. But it makes for quite efficient prioritization of research. We know what the PMs are looking for. We know what fits with our strategy. There's no kind of wasted effort there, or very little wasted effort there. And again, we've got people like Claudia that have been with us since, since 2003. We've got more recent recruits. We added a couple of people last year, including Joe Del Gaudio, who joined us from Neugebauer Berman. Mike West he came through from our research associate program. So we're developing more of our own talent as well. But a good experienced team there, supporting the efforts of the analysts. In terms of kind of coping and getting on with the job in this sort of COVID environment, some of us are venturing back into the office, quite voluntarily. The firm is certainly not pushing that in any sense. In fact, if anything, they're almost discouraging it. But we've always had, as a team, to work effectively when remote from one another, because we work normally out of 4 offices. We have people in London, we have people in Singapore, we have people in San Francisco, albeit most of us are based in New York. So when we do our research meetings, even in normal times, we're video conferencing everybody in, and we figured out a long time ago how to work effectively when whilst remote. So this it prepared us well for this environment. Our due diligence with the companies that we invest in and the companies that we're considering investing in, of course, we're having to rely more on Zoom and Team and those sorts of interactions. We're not able to have the in-person meetings currently that we normally have. What I will say, and we probably all found this to some extent, is without the travel time, there's more time for other stuff, hopefully much of it productive, more productive. So if anything, I think we've stepped up the frequency, the intensity of our conversations with companies, not having to travel. And to be fair, they've all made themselves very available. So there's no problem with, getting the finance director, whatever, the CFO, CEO of a company on the phone or on a Zoom call, if we've got questions to ask. They've been terrific at that. Just a quick refresher on philosophy and process, and then I want to get into the portfolio. What we're looking to do here, and what we've been looking to do since 1996 and certainly since 2014 when you first invested, is look for sustainable growth opportunities, companies that we think can grow into the future, that are hopefully benefiting from exposure to tailwinds of secular growth. So it's not just about calling the economic cycle. And then we've got a strong valuation discipline. So we want to buy into these companies at what we reckon are reasonable prices, given the growth that we're projecting that these companies will achieve. So it's growth at a reasonable price with a kind of thematic backdrop. That's essentially what we're looking to do. The themes that we're, yeah.
Do you mind touching on your ESG integration in the process?
Absolutely, absolutely. So when I talked about sustainable, that's a word we've used since inception. So sustainable growth to us, though, requires business practices to be sustainable. And that means operating in a way that, that if you like, doesn't offend. You've got to be a responsibly run company. If all you're doing is finding workers that you can pay the least amount of money to, and that's your competitive advantage, it's frankly not a competitive advantage, and it's not going to end terribly well. And you've only got to look at, say, Foxconn in Asia to see where that can lead. So sustainable to us, it has got to be understood in a broad sense. One of the reasons we spend so much time meeting companies is because we've always cared about governance. And that's not a box checking, matter of, well, is the CEO different from the chairman or whatever else. We think governance matters because we want to make sure that the company's senior people share our interests as shareholders, that they're aligned in some way, that their compensation is aligned, that they're running the company in an appropriate fashion. So all of these things have always mattered. Now, what has evolved over more recent times is broader interest. More people seem to be realizing this is important for different reasons sometimes. But B, there's also more tools at our disposal to supplement the fundamental efforts that we do ourselves in the course of our regular research. So we now have screening tools that we can buy off the shelf from companies like Sustainalytics or Refinitiv. And so we can screen a lot of companies quickly, and that helps flag up where there might be issues around E, S, or G. Most of these tools, we've discovered so far, at least, have shortcomings. I think it's interesting that the correlation between what Sustainalytics deems to be a great company and what Refinitiv deems to be a great company or not, they don't actually line up terribly well. So there's a lot of flaws in these tools, but they're helpful in terms of just providing an independent, a third party view on businesses, which sometimes maybe we're almost too close to, or maybe we've missed something. So I'd say ESG has certainly come on, even for us in the last 3 to 5 years. But we do it because we think it matters. We don't know how you'd invest successfully for long term if you didn't care about how a company conducts itself, how it sits within the broader environment, and how the ethics of the business, which touch on the social side as well. So we do it for investment reasons, and it's integral to the research.
Thanks, Jamie.
There is a slide on that now in the book, and in fact we've developed some other slides because we are getting more info on this, so we can now produce and share with you the companies that rank particularly well, and perhaps more interestingly the ones that don't rank so well, and what our engagement has been. We'll share voting stats. We vote all the proxies that we get. It's something that we certainly take very seriously.
Jamie, of all the companies you look at, what would you venture a guess on what % you drop from further consideration because of ESG issues?
It's quite rare that happens. But probably because things wouldn't tend to get very far through the research process if there was a serious issue. We have this quality bias, so if it's usually pretty well known if a management is somewhat suspect. If they're chopping down rainforests in Indonesia, nobody's going to even bother pitching that idea. So I'd say it's a small percentage. And one other thing I think, which perhaps means we don't often encounter these sorts of businesses, is we are growth biased. We're not looking for really cheap stocks the whole time. I mean, if we can get good growth stocks cheaply, that's great. But I think if you're scratching around in deep value, you're probably going to find companies that have more issues, and that's maybe why they look so cheap. I'll give you one example of a stock which was actually something we had briefly in the global portfolio, and that was Canada Goose. And we were aware of the certain issues around Canada Goose and ethical sourcing of raw materials, etc. But there was also some governance issues, which we probably shouldn't have bought it in the first place. And we ended up having done more work on it and get to know it a little bit better. We ended up exiting that one, but it's pretty rare for that to happen. We don't tend to invest in energy, and that's often where issues arise. Some of the sort of dirtier chemical companies, and again, we tend not to invest in those. Maybe invest in those.
Okay, thanks.
And when you score the portfolio using Sustainalytics or Refinitiv, we tend to score above average versus the market on ES and G. I'll just give you one last point maybe on these off-the-shelf systems is there is quite a degree of box sticking to them. So often what you find is that smaller companies score less well. And that doesn't, I think, necessarily mean they're polluting the atmosphere more, or they've got terrible governance, or they're irresponsibly run, or whatever. It's often they just don't have the resources to have policies in place on every single one of the 300 odd, questions that Refinitiv pose them. So if they can't check the box, they get marked down. So we see a definite size bias in terms of the scoring on Refinitiv and Sustainalytics, and that's a bit of a shortcoming. So I think you need to look through that a little bit. Okay, so maybe with that, I want to make sure I'm leaving plenty of time for portfolio. So in fact, why don't we skip to that and the performance, and then I'm certainly I can come back and answer anything else on process and portfolio construction if you'd like me to. This book was produced most of just prior to or too close to quarter end to have all the first quarter numbers in it, but I can give you a verbal update on that, and there's some raw number or some basic headline numbers in here. So what you have on page 17, first of all, is just a kind of review of Q4 and 2020, which all seems quite historic now, and obviously a kind of roller coaster of a year. For the first 9 months, well, the first 3 months, it was just carnage, obviously. And then we saw a recovery start to take hold in terms of markets and responding to the liquidity and the stimulus that was being issued around the world. And then, of course, fourth quarter, November, we had the first vaccines coming through, and that just lit the blue torch paper and markets took off. But what happened then also was you saw a big swing in style. So earlier in the year, it had been all about technology and kind of growth, and partly, I think, helped by the fact that bond yields were just coming down, going negative, and that just sent valuations skyrocketing. And it was really a year where growth at any price, certainly for the first 9 months, was the way to go. And growth at a reasonable price, frankly, we struggled. It felt like you had one hand tied behind your back, trying to invest with a valuation discipline attached to your growth bias. So it was an exceptional year in terms of the divergence between growth and value. And in that environment, we just didn't keep pace with the really growthier investors around us, or with the growth benchmark. In the fourth quarter, we should have done better because there was more attention to value, but almost swung from being one extreme to being the other. And we're not we're not typically in low quality banks or very cyclical businesses either. And that middle ground just got kind of left trailing, and that's something that kind of hurt us for the year as a whole. What we're starting to see this year, and just looking at the first quarter, is whilst value is definitely outpacing growth, people are starting, we think, to be a little bit more selective. So it's not like people are just piling into the most cyclical stocks there. There is a little bit of selection going on. And we think we're turning now into more of an environment which ought to suit us better, where growth at a reasonable price is rewarded. It's quite possible that value stocks in the most economically sensitive parts of the market will continue to do best for another quarter or two, because we think the economies are picking up steam around the world, and that's not all priced in yet. But once we get through that, I think people will be looking for growth again, albeit at a reasonable price, because you're not going to have this massive tailwind of just falling bond yields and lower discount rates that you can just pay the, whatever the sky's the limit for growth. It's going to be a more rational environment. So end of last year, Q4, first quarter of this year, energy, financials, deep cyclicals, they've made the best running in the last sort of 4 or 5 months. Healthcare staples, bond proxy sectors like utilities and real estate, they've done poorly. And then tech has been a bit of a mix. Semiconductors have done well, but a lot of the higher valued software stocks have struggled recently, partly because of the valuation compression as people have been applying, slightly higher discount rates. So if you look at our performance on page 18, there's 2 tables here. The first one are numbers to the end of December, and then the table below is updated to the end of March. So you can see in 2020, and we've shown here both the EFA index and the EFA growth index. You can see from the index performances what a massive difference there was between the regular benchmark and the growth. And then if you can imagine what the value index did, it's just another extreme again. So the growth index last year was up 18%. The EFA index was up 8%. We, for the year, kind of kept pace with the regular index, which wasn't a great result, but we were left trailing by the growth benchmark. For the fourth quarter, I said we should have done better. We would have expected to have done a little bit better, at least versus the growth benchmark. But it was, we had some stock specific issues, and a lot of our big positions just basically did nothing in the fourth quarter. And so that was, it was kind of hard to, so we were up in absolute terms, but we trailed both the regular and the growth benchmarks. This year, looking at the table below, you can see that for the first quarter, whilst we lagged the regular index, we were slightly ahead of the growth benchmark. And I think we've been picking ground up again so far this month. So it's early days, but we're encouraged by what we see as some evidence of a little bit more rationality in the market, a bit more selectivity. There's some attribution slides on 19 and 20. 20 looks at the full year 2020, and you can see that stock selection was really what kind of hit us versus the growth benchmark. And the areas that were we saw most value leak, if you like, was financials. We lagged significantly within financials. That was a big stock selection negative. Industrials, and then there was some sector allocation effects too. So in financials, we were predominantly exposed to exchanges, stock exchanges. We think it's a great business. Deutsche Börse is one of the two biggest holdings in the portfolio. It's been a great investment since we bought it first in 2016. 2016 actually didn't do that much, and then 17, 18, 19, it was a very good investment. Last year, it just didn't do a whole lot. And then we've had Aon. Should probably mention another consultant in Brit's presence, but it is a good business, and it's been a great investment over the years. But again, last year just didn't do a whole lot. And then in the fourth quarter, what really hurt us was just not having any of these banks, and the banks bounced very, very strongly in the fourth quarter. And I'll update you on where we are with that stance in a second. On page 21, you've got some individual stock holdings being kind of called out. And so for the year, I mentioned industrials was an area where we lagged, and Airbus was the stock there that caused us the problems. And you can imagine why that was becoming. It had been a very successful investment again for quite a number of years. We liked the fact that it's basically a duopoly between Airbus and Boeing, and we picked the right horse. And of the two, Airbus wasn't always the best managed company, in fact, far from it. But over the last decade, it's become a much more commercially orientated business. Great products, massive 10-year order book in effect. And then of course COVID hit, and everybody stopped flying, and their customers started canceling orders. So it will be around, Airbus, but we have exited, but not before taking quite a bit of pain, and so that we didn't see that one coming. We got out as quickly as we could at a reasonable price, but it was painful. Petrobras, I'd said earlier, we don't often invest in energy, and Petrobras was a rare foray into that sector for us. The reason we don't typically invest in energy is we just don't find much growth there. Most oil companies, they only grow, in inverted commas, when the oil price goes up. They're not actually replacing or increasing their reserves or production. But Petrobras is and was. It was cutting costs, it was making disposals, it was repairing its balance sheet, and it finally had what seemed to be a decent management that wasn't entirely at the beck and call of the government. And then again, COVID came along, oil demand slumped with people not traveling, and the political situation in Brazil also turned sour, and that kind of came later. But so we exited Petrobras, but again, not before taking some pain, and it had been a good investment up until that point. And then we had a little bit of financial exposure in HDFC and ING at the start of the year, which again we exited when COVID hit. So you get the theme. There were a few things in the portfolio when COVID hit that were kind of in the crosshairs, if you like, of all the all the turmoil, and that hurt us. On the positive side, we did have a number of businesses that came through very well indeed. In fact, if anything, almost benefited from the environment. For example, NICE is an Israeli software company that basically helps you run your call centers remotely. It's absolutely perfect for this environment. We were in that one already, and that was a strong performer last year. Obviously, Amazon, which we use our discretion to have even in this non-US portfolio, had a phenomenal time of helping everybody cope with not being able to go to the shops anymore. And in Europe, which is a huge market for them, there was a little bit of reluctance in places like Italy to do as much e-commerce as we all do here. And I can tell you, COVID's cured that reluctance, and people have embraced e-commerce just as strongly there now. And then Genmab is a smaller healthcare stock that we own. It's Danish, and they have a cancer drug called Darzalex. And that is proven to be hugely successful. And so we made a very nice return in Genmab. And in fact, we've sold half of that position, on valuation grounds largely. So there were some successes, but overall it was a disappointing year. We made some changes to the portfolio towards the end of last year, and we've made some more this year already, which I'd like to update you on. So on page 22, you can see we added 2 semiconductor companies. That was in Q4 of last year. One of them, in fact, we sold already because it was a very successful investment, and it shot up more than we'd even anticipated. And so we've sold NXP already. We still own Samsung Electronics, and you've probably seen in the press, it's a tight market, the semiconductor market, logic and memory. 5G phones require more chips, more memory. The automotive market, as things transition towards EVs, it's more semiconductor intensive. And then laptops and PC sales are up like 40% year on year. Everybody's having to kit out their homes as well as being equipped in the office. So the semiconductor market is strong, and we think will remain strong. So Samsung has been a great investment, and so was NXP. I talked about the stimulus measures around the world, and not least here in the US. CRH is an Irish company, but basically it's cement and building equipment and building materials. And we bought that, in fact, before the election, and it's been a successful investment. But we think that's got quite an exciting outlook. And then the stocks we were selling, partly the exchanges, which had played out quite nicely. We possibly should have sold ISA even a little bit earlier. Diageo, which we just found not to be that exciting, and the Medtronics, which we'd owned since about 2012, and again felt that was kind of fully valued. This year, and again with a change in our view on the economic outlook, and in anticipation of some normalization of the monetary policy environment in Europe, we've now gone back into a couple of banks. We bought BNP, which is kind of like the JP Morgan of Europe, with a good investment banking business. It's never going to be the fastest growing stock in the market, but it's trading on around 6 times earnings, less than 1 times book, and it's a well-managed business. So we've added that to the portfolio. We bought back into Allianz, the big German insurer, and they just had nice numbers the other day. And then we've also bought into Volkswagen, and the story there is partly we expect it to be a beneficiary of consumer spending recovering, but it's also already the biggest EV manufacturer in Europe. It sold more EVs in Europe last year than Tesla, and it's trading, I can assure you, at a fraction of the valuation. But we think it's got proven ability as a scale manufacturer, and we think by the end of this decade it's probably going to be the biggest EV manufacturer in the world. They've got 12 brands, so between VW, Porsche, Audi, and the others, we think it'll be the preeminent EV manufacturer, and it's cheap. So we've added that to the portfolio. So between what we've done in financials, and then again with companies like VW in the portfolio, we've certainly added a little bit of more economic sensitivity. But by and large, the portfolio we think is well orientated around long-term sustainable growth. Our tolerance, we'd say, our tolerance for a bit more economic sensitivity has gone up, and so so we've made a few changes along those lines.
Jamie, if you look at your performance, I guess back on slide 20, your stock picking within the sectors was where you really had the issues.
Yeah.
Financials, industrials, notably. Was some of that picking the wrong horse for financials, for example, or industrials, in light of the resulting pandemic, or the pandemic, or what was going on that caused those kind of selection issues there?
There's no getting away from it. I mean, we're bottom up driven. We consider ourselves to be stock pickers. When we get it right, that's where it tends to come through, and you'll see lots of positives there, hopefully in normal times. And when we have poor performance, it's usually because the stock picking's not been as effective. What I would say is I'd probably characterize it as being less about buying the wrong bank or buying the wrong airline, or it's more about within financials, we were in exchanges, not in banks. Yeah. Or when we had banks, they were at the start of the year, not in the final quarter of the year. So there was some with hindsight, some poorly timed decisions. We either shouldn't have been in banks at all, or else just stuck with them, or bought them for the fourth quarter. So partly it was timing and when we had the exposure. More often than not, it was just being in the kind of the wrong areas. And I say wrong and judged on that time frame. We think financial exchanges, stock exchanges, are a better long-term bet than banks, notwithstanding the compliments I paid to BNP a moment ago. We think BNP is probably the best of a relatively bad bunch in Europe. We think Deutsche Börse, London Stock Exchange, nice. You go any number of exchanges around the world are generally better investments than your average bank. So probably the wrong industry within a sector more than the wrong stock.
Yeah,
would be the way I would characterize it.
Just to follow up on Europe, when do you see Europe kind of coming out of the woods with vaccines and getting the economy opening up again?
Yeah, it's well, you know what, there's been slightly better news recently. I mean, France has made a complete botch of it. There was allegedly a bit more vaccine skepticism to start with in France. The last thing they needed to do was throw fuel on the fire there, and yet Macron kind of managed to do that with the stop-start policy on the AstraZeneca drug. And the EU was rather slow in terms of agreeing pricing, and it's a bit cumbersome. So they've been slow at getting the vaccines out there. It's starting to happen now. They're a long way back, but it's really accelerated. So they're probably a good 6 weeks behind. The US, the UK is about where the US is, but France and Germany, which are obviously really important, and Italy are quite a long way back. But they'll get there. We're pretty sure about that. And certainly the vaccination programs have accelerated. So I think they're now up in the kind of 20s or even 30s in some cases. They're getting there. And again, some of the things we've seen here. So there's been a lot of stimulus. There's more to come. There's a lot of savings rates have gone up during the crisis. So there's a lot of pent up spending power and spending desire, so that'll be unleashed in due course. And then right now there are still quite severe lockdowns in parts of Europe. So people are just, I think, hopefully by the time we get into kind of June, July, maybe we'll salvage something from the end of the summer and people get traveling, get spending. So we certainly expect that to come through.
Okay.
We have numbers for February, up only until February, but going back like 3 years, the index that we use with you've underperformed by 260 basis points, and over 5 years by 234 basis points. Is that because your portfolio is not aggressive, or stock picking is poor? Or, I mean, that over 5 years, 200 basis points is on $40 million is a lot of money.
Yeah, I mentioned that last year saw an incredible divergence between growth and value, and we're more growthy than value for sure. We're on the growth side of the spectrum. That's why you have us. But it was a very polarized market, and it wasn't just last year. It was true the year, but for 3 years now, it's been an incredibly polarized market. In fact, the last time we had even a quarter where value outperformed growth was probably the fourth quarter of 2016, and even before that, growth was still doing very well. We did some analysis looking at how we have fared in different environments over the last 25 years, and in most environments, we cut the returns periods, trailing 12 months, trailing 36 months, and we put them into buckets of, like, when growth outperforms value by 0 to 5%, 5 to 10, 10 to 15, all up to 20 to 25%. And we did it the other way, for value outperforming growth by each of those amounts. And 80% of the time, growth outperforms value, or value outperforms growth by 0 to 10%. So it's a typical bell curve. 80% of the time, you kind of plus or minus 10%. In those environments, we've consistently outperformed not just the regular index, but the growth index. So we've managed to do both. When you get to the extremes, if it's value shooting the lights out, outperforming by 25%, doesn't happen often. It's rarely happened. We will outperform the growth benchmark, but we've not outperformed the regular benchmark in that environment. What's happened recently is we've had this extraordinary level of outperformance by growth of value, and in that environment, our valuation discipline, I think, has we have underperformed. We've still over those periods outperformed the regular benchmark, but the growth benchmark we have not kept pace with, and I think it's because we find ourselves selling stuff. Almost anything we sold for valuation reasons in the first 9 months of 2020 just carried on up, and it would have been better to close our eyes and just kind of hang on and enjoy the ride, because that valuation discipline was not rewarded. Something I think you will see, and I hope Brett would be able to substantiate also, is over the last 25 years, 10 years, whatever, when you look at the ups and the downs of markets rather than say necessarily the styles, we've fairly consistently added value in up markets, but unusually we've also managed to protect capital in down markets, and that's where the payback comes from the valuation discipline. But you just haven't seen much of that in recent times, and so the last 3 years have been particularly challenging, and that's put a hole in the 5-year number too. So we think the process is absolutely fit for purpose, but we think we've been operating in a quite an exceptional environment, which we don't expect to last. And there's signs of it. There's some signs of it changing, and people maybe, the way I'd see it, sobering up a little around growth.
Thank you.
But we're disappointed with the returns, and we would expect to outpace the regular index and the growth benchmark with what we do on a regular and long-term basis. And we're disappointed that that's not happened.
Does anyone have any other questions? Or any other comments, Jerry? And if not, we're going to thank you for your presentation.
Well, thank you all, and thank you all for continuing to have confidence in us. And I hope that next time we talk, I can show some much rosier numbers, both in absolute and in relative terms. So thank you, and take care.
Thank you.
Thank you.
Thanks, Jamie.
I'm going to move on to performance review. Britt.
Thanks, Frank. And I think, just to comment on Artisan and their investment process, I think it's important to note that, one, they really are benchmark agnostic. So they're not weighting sectors or market caps according to any benchmark. They're really stock pickers, and they're not a high octane growth fund. They have a valuation and a quality bias, which in the last 10 years, where we've seen growth across the world skyrocket, they're not going to keep up. Where we would expect them to outperform is year to date, where we've seen a rotation away from the really high octane growth stocks and into more of the value stocks. So we'll continue to monitor them. I don't think anything from their performance over the last 3 and 5 years is all that surprising given their investment process. So just wanted to point that out. And, while we're disappointed in their relative performance, we do have confidence in that team, particularly Mark Yockey, who leads the team going forward.
Brett, do we have any managers on a watch list currently?
We do. I haven't discussed it because of public sessions and virtual meeting land. I'm happy to discuss them if you're comfortable with me talking on the open forum.
One thing, I would be maybe a little uncomfortable with that, but the other thing is, my understanding, or I'm hearing rumors that City Hall will be reopening in the next few weeks, or certainly be quite likely before the next scheduled pension board meeting. Maybe towards the end of the meeting, we could discuss whether we would have our meeting in person. I know I've gotten both vaccines. I don't know if anybody else has, but that might be something for a discussion towards the end of the meeting. As a result, if there was a meeting in person, then Britt could go over any watch lists.
Yeah.
Is that okay with everyone?
We can't make any suggestions currently, or we're comfortable with this situation.
I would say if you want to put Artisan on watch, given their performance over the last 3 and 5 years, we can certainly do that. I would say structurally from the team and the process, we do not have concerns, though we are certainly disappointed in their relative results.
I mean, at some.
One question, I guess, is Frank, you were citing the 1, 3, 5-year performance for these guys. Britt, how much of that has been driven by 2020? It's obviously the end point in the number, but is that really, how are they doing up to 2019 if you take 2020 out of the picture?
Yeah, I don't think it's just 2020. I think if you look at the market cycle over the last 3+ years, in the fact that growth and companies that, do not have those quality balance sheets and that valuation discipline went straight up. And those are names that Artisan historically will not hold. So I would say it goes back longer than just 2020, probably back more to 2017, 2018.
Is this their ESG filter biting them a little bit because they're looking for bigger companies only?
I think that is a part of it, in the sense that they are looking, that quality, sustainable company bias is not what has gone up, so to speak. And I think that has hurt them. But that being said, I think when markets rotate out of that market environment, and we've seen that over the last 4-5 months, you're going to see them outperform, in particular in more of a down market environment.
Yeah. Okay.
I think what's frustrating from my perspective is we obviously know the difference between value and growth. And it's clear from a growth perspective, they're not, nowhere near their benchmark, right? I mean, if it was a blended manager and it was a blended scenario, it's easier to, deal with their performance, but they're benched against a growth benchmark, period, cut and dry. It's not like we don't have a value guy in there as well, Silchester. So that's the frustrating part on this end.
I do agree with that. And I do, we do need cash, and they are they're 8.5% or so of our, they're 8.5% of our funds. That's 1/12 of our money, and they're underperforming for 5 years, and and Chitsame is requesting money. And I mean, there's still, if we took the money out of Artisan, there'd still be a reasonable amount of funds. And
I do have a rebalancing analysis to discuss, especially in light of the new asset allocation. So I'm happy to go over that after the flash report.
Okay.
Okay.
Onward, Britt?
Sure. We on performance for the pension?
Yep.
Great. Bear with me here. Okay. Can everyone see my screen?
Yes.
Great. So total assets as of the end of February were about 514.4 million. I would highlight that the target asset allocation on this page has not changed since the board adopted the new asset allocation, which was done at the March meeting. So following in March, these will be updated, but based on the old asset allocation, you can see that the overweights continue to U.S. equity and global equity long short.
Hey, Britt, can you blow it up just a little bit?
Sure. Bear with me here. Let me try another. Nope, that didn't work. How's that?
Better, much better. Thank you.
Sure. So while there's an overweight compared to the old asset allocation targets, you can see 30% versus 20% in U.S. equity. You'll see in the rebalancing discussion that you're actually underweight to U.S. equity based on the new targets. So I won't harp on any of the underweights or overweights here. Would note a few things. One, the $8 million came out of the BlackRock Russell 1000 index fund. So you can see cash was about 9.4 million at the end of February. Today, Chit's may can update us in a few minutes, but I would guess that's down closer to about 3.5 million, given the benefit payments over the last few months. In addition, at the last meeting, the board voted to withdraw 8 million from the Blackstone Global Equity Long Short Fund. That has been submitted, and those funds are expected to hit on July 1st. So I wanted to make the board aware of that. In terms of returns, fiscal year to date, returns have been exceptional, particular in U.S. equity. You can see the U.S. equity composite up over 35.4%. BlackRock Russell 1000 index up over 27%. LSV, you can see while they're trailing their benchmark, I am happy to report that as we have seen this sector rotation over the last 3 or 4 months, they're up about 250 basis points through early March. So good to see them outperforming in a market that we would expect them to, but we'll continue to keep a close eye on LSV. Columbus Circle, really extraordinary returns, up over 20% versus the benchmark fiscal year to date. You can see over the trailing 12 months, I don't think I've ever said this in my career, the fund returned over 100% on an absolute basis and up over 40% versus the benchmark. And in international markets, we discussed Artisan at length, and they continue to trail that growth benchmark. We'll continue to keep an eye on them. Silchester has outperformed fiscal year to date. They've had a good last 2 quarters, and you can see their long-term results continue to be very good. BlackRock Emerging Markets, strong fiscal year to date, up over about 66 basis points versus the benchmark, and over the trailing year up about 1.5%. So good performance from them. Within global equity long short, you can see both ABS and Blackstone on an absolute basis up around 18 and 19% respectively, while they trail that HFRI fund of fund strategic index over the fiscal year and 1 year. You can see over the longer term, they continue to do well. So no concerns there. And your private equity funds have performed well. You can see up about 12.5%, which is really as of September 30th, given the lag in performance data, and up over 21% for the trailing year. Within fixed income, both of your domestic fixed income managers have outperformed the benchmark. Metropolitan West has done very well. You can see up about 2% versus the benchmark over the trailing year. UBS, your absolute return manager has performed very well, up over 9% for the year, and longer term returns relative to their index continue to be good. And PIMCO, really strong returns. Emerging markets in the fourth quarter really bounced back, and some of their exposure to those risk assets within that fund performed very well. So from a total fund standpoint, fiscal year to date, the total fund up almost 20%, over about 3.5% over the benchmark. And you can see over the trailing 1, 3, 5, and 7, really strong returns on an absolute and a relative basis, and well above the discount rate. So great to see there. I did want to ask, in terms of next month's meeting, on a manager to bring in. We haven't had UBS in a while. Was going to suggest UBS unless the board had another manager in mind.
Yeah, I think we should have whatchamacallit, Columbus Circle, and just see if they can sprinkle dust on us or something.
Yeah, unbelievable.
Yeah, and remember, Cliff Fox, who was a longtime lead PM there, is retired. So while we are certainly excited about their performance, we're still keeping a close eye on the team. and process to make sure that that continues to stay intact.
But I know we've been beating this to a dead horse. The PIMCO all asset, they were in recently, weren't they?
They were in last year, I think the fall of 2020, I believe.
Okay. Okay.
How much money do we have at UBS again?
24 million.
24? Okay. Okay, got it. Yep.
Do you know, because we have so little money in infrastructure, should we like almost at some point here delete this as a
Category.
line on fiscal year to date?
Yeah, we will, when it's totally cashed out, we will remove it from the performance report, but considering there are still funds and for tracking purposes, we believe it's best practice to continue to report on them, even though it's, $10,000 in the accounts. And
Why don't you collapse it into the real asset category?
sure, are you okay if we leave it on this page, but in performance, we collapse it into the real asset composite?
Yeah.
Sure,
Yeah, it's fine. Not gonna make any
that's
difference.
fine.
How about Zessinger? What's going on with anything new there?
Jim, we did receive an update, I think last week or the week before. I can certainly forward it to you. I would not say the outlook is promising. I think it's just a matter of time before that value is written down.
Yeah, okay. That's not, no need to send anything. I was just curious.
Yeah, there's a product that they've been trying to raise capital, and I think the pandemic delayed the inevitable, and it sounds like they're closer, but considering the debt in the underlying investment, I don't think current investors are going to get much, if anything, out of it.
We're gonna have to pay them to get that off our books.
Well, I got that letter, and I do think they said they need another round of funding, and they weren't very optimistic as to what the old shareholders would come out with. So,
Right. So,
and I think you're right. I got to believe that that's, just a matter of time before we write it off.
yep. But we'll continue to track it, and if we hear more, sometimes their letters are interesting to read, but not sure what the outlook really is. Any other questions on performance?
Performance? If not, Chitsame? Maybe Chitsame could speak about her need for cash.
I sent an email out regarding our pension payroll, our monthly, how much we pay out each month to the retiree. So it fluctuates around 2.7 million to 3 million. And we're probably at that now going forward. Right now, our available cash balance, I mentioned, was around 4.4 million. We just ran our April payment, and that came to about 2.8. So I'm drawing that down. So we're gonna have about 1.2 million left of cash. And to get me through June 30th, I'll probably need 5 million of cash to get me through to, for those 2 months of May and June.
Okay, and another, Chitsame sent out an email regarding pension expenses. And I had sent her an email because when the actuaries were here and they had expenses broken down by city employees, fire, fund, police, and the total in 2019 had been 42,000, and the total for 2020 was 617,000. So that was an increase of nearly 575,000. And I'm grateful because Chitsame went ahead and I believe, or you could speak, but I do believe you contacted the actuaries and that was corrected.
Yes, I contacted the actuary to get more detail of what numbers were being used for that. And then we discovered that they were using a wrong category for those number. So what we're going to do is have them redo our valuation. I know I talked to them a little bit, and I don't think that there's going to be that much change in the ADAC, maybe a few thousand, but we want to make sure we get an updated number.
Job.
Any questions for Chitsame? Then we will perhaps after the rebalancing discussion, vote on where the funds will come from. If that's okay with you, Britt?
No.
Okay. Okay, so if there's no other questions on performance review, I want to thank Chitsame, and then we'll go to the rebalancing discussion.
Sounds good, Frank.
Okay, Britt?
Great. So we put together this analysis and we wanted to show what the asset allocation you can see in column F
You build
looked
that up?
like. I can try. Is that all right?
Yeah, that's good.
So we wanted to show the asset allocation versus the old target and the new target, and understanding at the last meeting when the board approved the new target asset allocation, you expressed, a desire to really kind of ease your way into the new asset allocation and not necessarily make huge rebalancing steps immediately. So in that context and understanding that Chitsame needs another 5 million for benefit payments, the most reasonable rebalance for Tom and I was to raise 10 million from PIMCO, which is currently at 9.15% versus a 6% target. And if you raise 10 million with those market values, you'll still have an overweight to PIMCO in the real asset at 7.2%, but it does reduce it. And we would suggest contributing 5 million of that to the BlackRock Russell 1000 index to slowly raise the target to US equity, as you're at about 30% versus a 35% target. The thought in continuing to reallocate to the asset classes where you're overweight and underweight is really taking into account, one, the global equity long short redemption. So, that $8 million out of Blackstone is going to reduce the total equity exposure further. And we also know that the city's contribution for the next fiscal year will be coming in some point this summer, most likely. And we can use those funds to really shore up the US equity allocations and the domestic fixed income allocations as necessary.
Britt, how would you do that in terms of actual trades? Would you one big trade, 3-4 trades? I mean, how would you spread that over the next couple of months? I mean, Chitsame needs some money now, I get that, but
yeah, so we're suggesting raising 10 million from PIMCO,
right.
And investing 5 million of the proceeds into the BlackRock Russell 1000 index and leaving the other 5 million in cash to pay benefit payments.
And that would be just a $10 million redemption request, and then all in one, just do it in one transaction, you're saying?
Yeah, so PIMCO is a mutual fund, so it should be pretty simple to make the withdrawal request, and then once the funds hit the cash, then we can direct the purchase of the BlackRock Russell 1000 index.
Personally, I really do follow commodity pricing, CPI, et cetera. And I always felt that that was a place where if there was inflation, we would benefit. And, you know, if you look at the CPI, was what, up 2.6% over the last 12 months. That takes into account April of last year, which was down 0.7%, which means that if the number comes in unchanged next month, the CPI is going to be like 3.2, 3.3%. And I do think that, you know, when you're talking about chip shortages, you're talking about freight costs going up, you're talking about lumber. Lumber's tripled since October.
Mhm.
I am, you know, I listen to Powell and he's awfully dovish, but I don't know how he defines transitory because, and if you look at the CPI had shelters up 1.4% year on year, and housing prices are up 14%. And there was a piece that was written by a man of Bernstein talking about how over 50% of the CPI now is assumptions. And I don't know about you guys, but when I go shopping, I'm kind of surprised at what things cost. You know, oil's strong, you know, right across the board, there's commodities are strong, grains are strong, lumber's strong.
I kind of,
Wages are going up. If they raise the minimum wage to $15, it's certainly wages. In fact, I think in the CPI, I didn't look as closely because I was traveling this past weekend, but so I didn't really look over Friday's numbers as closely. But the previous month, the average wages were up over 5% year on year. So I don't, I really kind of feel like, in fact, another thing about eliminating commodities, I wouldn't say we're going to put money into commodities, but I think it should, and it can be 0, say to 5%, like we once had it years ago. But there might be places here where there could be an interest in having some kind of inflation hedges.
Frank, along those lines, PIMCO All Asset is probably the most correlated, most exposure we're going to get to what you're referring to, and I agree with that. It sounds to me we're going to be fairly flush come July, right? We're going to have city money. We're going to have Blackstone money. I would be more in tune to do the rebalancing at that moment. I can't see buying the BlackRock. I like the market long term. We're at all-time highs. You know, I look at this as like a garden, and I look at what's going on, and we have a weed in the garden. We have an underperformer. I'd rather take the $5 million from Artisan at this moment in time, and then address the rebalancing when we're flush with money come July. That's my take on it. I think the PIMCO All Asset category is going to give us a close exposure to the commodities that you're referring to, Frank. Now, it's not a commodity fund. I get that.
Right, it's not a commodity fund. And I do believe too that, you know, when they talk about their 3-stool approach, 1/3 of it is stocks, if I'm not mistaken, right? So
Yeah.
that it's kind of an exposure in stocks. And I would, I would probably support a motion that we took the money from Artisan. I don't think that, you know, they're, like I said, their 3 and 5 year performance, you know, is below the index. So that, I mean, I guess when somebody talks about, well, 2020 was a tough year, okay, that's fine. But you
Tough
know
for
what,
everybody.
we're talking about 2016, 2017, 2018, they underperformed. And
I would
and
just
that-
say,
but if the other thing too is they would still have, let me see, I just want to, so I'm not,
40.
I mean, you know, they're still going to have like a reasonable amount of money. You know,
They're still going to have 38 million.
right.
I would just say
More-
from
More
a,
than Columbus, and Columbus is double.
yeah, I mean, I think from this proposal is based on your strategic asset allocation. We're not trying to be tactical or guess what inflation is going to do. We know that you have over 3% overweight to real assets in the new target asset allocation.
Right.
If you didn't want to raise 10 million and you only wanted to raise 5 million, we would still say that is where we would suggest doing it from.
But
I would
you-
say that Artisan, this is the point in time of Artisan where I would expect them to do well, and selling them at their worst would not be Callan's suggestion. I think there are other areas of the portfolio that are, I mean, significantly overweight versus the target. If you choose to not take it from there, that's understandable. But from our standpoint, looking at this tactically is really not something that we do or recommend doing. And I think the target asset allocation and the ranges are there for a reason. And we're simply suggesting raising the cash from an area that is significantly overweight.
Right, well, excuse me.
What
but
area,
it-
who would you, where would you look for 5 million then?
We would suggest taking and raising any cash at this point from PIMCO, given the large overweight.
I mean,
Well,
other than
but-
PIMCO, what would be on your list?
Pardon?
Well, I think it's tough because
Yeah.
from an asset allocation standpoint, you're underweight US equity by 5%. So taking it from there, given
Excuse me, I don't mean, I'm sorry to interrupt, but these are proposals that you're making. We still have, these are proposed changes, if I'm not mistaken. We still have already right now, a structure. And so I don't think we're so far out of line when you look at what we have right now, right? I mean, these are, what you're showing us right now is a proposed change. It is not a change, because we have we should be having a discussion about this, okay?
I
And
agree.
so it's not written in stone. So we, just like I said, I would like to see, I'm not proposing we put money in commodities right now. What I'm saying is there should be an opportunity to do it. Just like there's one other category, and I don't have it up on my screen right now, that you're proposing to eliminate. And it's like, if we have them set at 0 to 5%, we don't need to eliminate them. Okay, that's what I believe. And I think that Joe and I feel that we have not accepted this proposal yet. Perhaps we will. Maybe we'll make alterations, because I know that we have a lot of respect for your opinion, and you've given us much good advice. But the rebalancing discussion, I think, again, when PIMCO's 1/3 stocks. So I've always looked at times, I like the idea that we're a little overweight, and I obviously have liked US stocks. That's what I do myself. And the thing is, by having some money in PIMCO, I always felt that was kind of adding to our portfolio of stocks.
Well, we're still, even if we do nothing with PIMCO, we're still within the new range. We're above the target, but the range is
Right.
4 to 10. So if you leave PIMCO alone, we still line up with the new asset allocation ranges. So, we don't have to do anything with PIMCO to, if we do,
Right.
doing nothing with PIMCO doesn't mean we're out of line with the new targets, the new
Right.
range.
Agreed. And Frank, I'm not, trying to do anything but give you our best thinking, and that's all it was. And it was really just from a strategic standpoint. Certainly understand
Right,
all of your comments.
Right, we get that. We get that.
Right.
We get that.
So Brett, what would be, if we needed to raise $5 million and we want to leave PIMCO as it is, what would be on your short list?
Well, I think you have two options considering the illiquidity, right? So global equity, long, short, private equity, and absolute return are really off the table. In terms of overweights and underweights, you're less underweight to fixed income. So the Prudential Core Bond Fund or the BlackRock Russell 1000 Index Fund would be two alternative options if you wanted to raise capital from those asset classes.
Raise cash quickly.
Correct.
Yep.
Jim, what do you think of Artisan?
Well, first of all,
Joe?
I agree with you on your thinking on PIMCO. I've had, we had the calendar discussion about the capital markets, and I was surprised to hear 2.5% over 10 years on inflation outlook.
Yeah.
So I think it's going to be higher. So I'm fine. I actually like leaving money with PIMCO as well. Artisan, maybe they are getting ready to turn a corner. That's why I asked that question about if you take out 2020, how do they look? And if they've been underperforming for 2-3 years, maybe they're, and they're growth oriented, not value. So, it tells me there's something that doesn't feel right there.
But, if you looked at 5 years ago, Artisan, and you said, well, they're underperforming because they're like down, 235 basis points 5 years ago. And you said, well, why don't we, it looks like they might be turning the corner. So then you go, okay, let's wait 2 years. And then after you wait 2 years, now they're down 260 basis points. So, I mean, turning the corner, sometimes people try to turn corners and they're in a circle. It just, and again, if we take $5 million out of them, it's still not that they have more money than a number of others.
Yeah, I think my only comment, Frank, would be that Artisan and Silchester were designed to complement each other and be similar weights in the portfolio. So you have a value component and a growth component that together outperform the broad international developed equity market. Obviously, there are some differences there currently, but just wanted to point that out from a asset allocation perspective.
If we asked for like half the money from Artisan, where would you ask for the other half, Rick? As a compromise.
How about ABS and Blackstone?
Well, you remember that Blackstone, $8 million is coming out of Blackstone,
Oh, that's right.
but that won't hit till July 1st. So I would suggest Prudential domestic fixed income if you wanted to split between Artisan and another manager.
What does anybody think of that?
I make a motion to take off $5 million from Artisan.
Well, you were talking, I think, Frank, about 2.5 or 3 from Artisan and 2.5 or 3 from Prudential, right?
Yeah, would that be, what do you think of that? If we say, how about, because if we said, say 3 from Artisan and 2 from Prudential, would that be fair, do you think?
Works for me.
Sure, Frank, we're cutting hairs, but that's fine.
Yeah, I'm trying to make it so that, we're all gentlemen here, right? So, if that sounds reasonable to the two of you and somebody proposes it and seconds it, I think we could have a vote on it.
Go ahead, Jim.
I propose that we redeem $3 million from Artisan and $2 million from Prudential fixed income.
I second that.
All in favor? Aye.
Aye.
Opposed? Passes. So Chitsame, you'd be doing that, right? Thank you. And by the way, it's too bad that Jim isn't here because here I am. We had an opportunity to take even more money out of bonds, which I hate. So see, I was compromised.
Someday you'll be happy we have money in bonds.
Yeah, someday. Just not
Someday.
in my lifetime. Okay, you want to continue on? I mean, we did jump into the funds needed, but do you want to just, oh, I know, one other thing I wanted to mention about rebalancing. The amount of cash right now is it's like 0 to 2, I believe. And the only thing is that, I mean, I'm not big on having cash available per se, but because the funds that are coming in are going to be diminished because we just had nearly 50 people retire. And they're going to all be getting funds. And I noticed like Chitsume's spreadsheet, soon we're going to be at $3 million a month. And the funds coming in from employees has gone down. Perhaps doesn't mean we're going to hit that number, but and also to have a reserve, for example, during the summer when we don't have meetings and the possibility of capital calls, there's still potential for that within private equity, that maybe we just made that instead of 2%, 3%. It's not a big deal, but
You mean
just
the cash
the
percentage.
cash, yeah. Because at some point, there is going to be a time here where we're going to need more and more cash just
So-
to satisfy the pension requirements.
In July, correct me if I'm wrong, we're getting 8 million from Blackstone. And what is the city contribution this year? Does anybody know that?
I think it's around 14 million.
Okay, so we're gonna have about 20 something million to work with in July.
Right, which would be above 2%.
Yeah, so the idea and the thought was to bring a formal rebalancing recommendation to the June meeting in anticipation of those funds coming into the pension in terms of deploying them before the summer.
Hey, Britt, along your comment about the international split between Silchester and Artisan, I understand that and I get that. Does BlackRock have an international growth index that potentially, if we needed to balance that out, we could park money in there for the time being? Not that we're going to need it right now, but do they have something along those lines?
I'm sure they do. I mean, I would suggest, we can see what the portfolio looks like come June. I don't think using another indices to park money over the summer would be our ideal way of implementing this, but
I'm not looking. Okay, I got you.
Oh, the other one, by the way, is I'm not a big fan of infrastructure really, because we got burnt a couple of times, but just the idea of not eliminating it and leaving it in and have it at 0 to 5%. Do you know what I mean?
Frank, we're happy to leave all of that in the IPS. It was just a suggestion because it hadn't been in the portfolio, and you can always add it back into the portfolio in the
Right.
IPS.
Yeah,
So we're
we
certainly happy.
We wouldn't have to go through a change in the IPS if we just left it there.
Not a problem at all.
Whose definition of infrastructure are you going to use?
Yeah.
Does it include daycare centers?
Yeah, we're gonna buy daycare centers and that's infrastructure.
Well, I see where this is going.
It's a broad range now. It's a broad.
Well, isn't infrastructure a real asset?
You're muted.
Yes, it is.
Yeah.
That was a joke. Let's get going.
Yeah. Okay.
Okay.
So
Should we go through
we're
the
not gonna vote on- we're not-
IPS?
yeah, yes, we're done with the rebalancing discussion. And why don't we say that we're gonna have the final vote in June? Would that be reasonable?
Yes.
I don't know if you heard me, Britt, but the final vote for the for the rebalancing will be in June.
Sure, not a problem at all. And we'll work with Chitsume to get the formal number from the city, combine it with the Blackstone redemption and make sure that we have a complete rebalancing analysis before we break for the summer.
Yeah, and if anybody has any comments, if they could forward them to Britt, that would be helpful. So next topic is the IPS review.
Great.
Go to it.
Thanks, Frank. So given the adoption of the new asset allocation, we wanted to revisit the IPS. I think for the most part, our edits are pretty minor, but I will walk you through them here. Hopefully everyone has had a chance to read it. So one point that Tom and I, when reviewing the IPS, we wanted to make sure there's this section E here under investment managers where it says written quarterly reports shall be sent to the board as soon as reasonable upon completion of calendar quarter. I know that at Callan, we receive quarterly reports from all of your managers. I believe Frank receives quarterly reports from most, if not all of them, but we don't know that the entire board does or wants these quarterly manager reports. So we just thought we'd highlight it. One possible way to soften the language would be, written quarterly reports shall be sent as requested upon the completion of calendar quarter. Just wanted to see what you thought about that suggestion, given that we aren't really sure who is actually receiving these reports.
I think the only one something that I might want to see would be the quarterly reports on our watch list managers.
Sure. No, we can certainly do that.
Does that need to be in this or no? Not really.
No, it doesn't. It's more of if this is in your IPS and it's not actually being done, then we want to make sure it's addressed, either to make sure the entire board receives the quarterly reports or to soften the language so that the board can see the quarterly reports as they request them.
Gotcha.
Yeah, I would go with the as requested language.
Yeah, I agree.
Yeah. I mean, the other thing too is we could just simply have, Britt, you could forward anything if we had a request. Like I do read them over,
Certainly.
And I forwarded Silchester's to Rich. It was a good one. That's why it was good. So I sent it to him.
Absolutely.
I felt that he was a real proponent of having us add funds to them, and he was right about it.
Yeah, they're pretty thoughtful in their pieces as well. But Joe, to your point, if there's anything that you want to see from any manager, please just reach out and we're happy to send it your way or get in touch with the manager to get you whatever you need.
Thank you, Brett.
So we'll update that to make as requested. Just a simple grammatical edit here. We did update the asset allocation ranges based on the discussion last month. Frank, to your point, we can certainly leave both infrastructure and commodities in. We do not have to delete them. We'll just make them a 0% target.
Yep.
Otherwise, these have been updated based on the new asset allocation that the board adopted.
So you'd have them, you'd have the target 0, but an upper limit of something.
Yeah.
Yeah, I
Say-
think we'd 5% or 6% or something like that, if that's reasonable.
And this was the cash one where, like perhaps to go to 3, only because, yeah, I mean, even if we got the 8 million and the 14 million from the city, technically we would be over 2, we'd even be over 3, but just to make that, it seems like a minor change. I don't think anybody's gonna be concerned about it, but.
No, that makes
Sure.
sense.
So we can update cash to an upper range of 3%.
Yeah.
And we can leave infrastructure and commodities in with a 0% target, a 0% lower range, and a 5% upper range. Is that reasonable?
Yeah,
Great. Then just a couple minor grammatical edits
I want
below.
to go back to the infrastructure thing. I mean, isn't infrastructure a real asset? I mean, are we actually going to buy a toll bridge again? I mean, isn't I
The
understand
one in Alabama.
I understand commodities being an asset class, but infrastructure, it's part of the real asset category, even though our real asset is PIMCO. I don't know.
Right. So in the IPS, the liquid real assets, that really represents PIMCO. It's a mutual fund. They invest in various real assets from commodities to various equities and fixed income products. But previously, the board had a dedicated allocation to infrastructure itself. And that was in a closed end.
That was previous.
Correct.
Going forward, are we ever going to look at buying a toll road again?
Maybe we won't, but if we thought we wanted to, it doesn't hurt to be there. I think the other thing was the difference between, like, say, PIMCO and infrastructure is that the infrastructure is almost more along the lines of private equity in that it's not a liquid asset. At least in the past, what we had was we had for many, many years. So I guess that's where I would, liquid real infrastructure isn't liquid real assets to me, because the word liquid changes it.
Well, do we have to have
Infrastructure's not-
liquid under real assets? Just take out liquid, call it real assets.
Well,
I think Frank said, point out that there are two categories of real assets. We have the liquid stuff, which is, the PIMCO, for example, and we have the more private equity stuff. So maybe the answer is to, instead of say total real assets, call that one liquid real assets, and then have infrastructure as another category.
right. I think that's why it's that way.
I mean, if that's okay.
Yeah, I think that historically, this has been the case because of the close-end fund nature of the infrastructure investments that Norwalk had made. There is such thing as open-end infrastructure where it is more liquid. I mean, we can adjust this as you see fit. I think in our hearing everything that everyone has to say, my suggestion would be to simply leave infrastructure and commodities in with a 0% target and a 0% lower bound.
Okay.
That's fine.
Perfect.
Yep.
All right.
Done.
Great. And then one thing we only have really two separate accounts, LSV and Columbus Circle, but under the U.S. Equity Manager guidelines, it included closed-end funds, which are more of that private equity, a liquid type nature. And we spoke to our global manager research group, as well as both Columbus Circle and LSV, and everyone agreed that this should be removed from the U.S. Equity Manager guidelines, simply removing the closed-end portion of that sentence. Which is really just a reference to illiquidity.
Yeah, Brett, looking at the top of that page there, would you venture a guess on what % of our assets are in some sort of commingled or pooled investment account? I mean, have a big qualifier in here. Nothing in here, it doesn't apply if you're in a pool. Is that 5%, 20%? What would you guess?
I would much higher. I think LSV and Columbus Circle are your only separate accounts in the entire pension plan.
So most of what follows from paragraph A and on doesn't apply for most of our.
Correct. It might in the future. I think it's good to keep it in.
Yeah, it's fine. I was curious what the percent was. Yeah.
And sometimes separate accounts can be advantageous fee-wise at a certain level. So
Britt, your definition of closed-end funds is illiquid securities. Is that correct?
Well, It is more illiquid. So in this case,
I mean, there are closed-end funds that trade on the New York Stock Exchange, okay, that are closed-end funds.
Right.
right.
I mean,
Right.
so
I think essentially when discussing this with our research group, as well as the managers that this applies to, they are understand and are completely fine. It won't change anything if this is removed from the IPS.
I think what Joe's mentioning is, there are times where some of those closed-end funds have traded at steep discounts. And would that be a start, would you, I don't know that anybody investing, but, if someone was running a stock portfolio, they might buy a closed-end fund stock. Is
Yeah.
that what you, Joe?
that's what I'm referring
You know,
to.
Right, because it could have a steep discount. I mean, I've seen them trade minus 16%
For
or so.
example, there's a couple of infrastructure closed-end funds trading at discounts to net asset value right now that are liquid infrastructure plays, but that's another story. This eliminates the ability to buy a closed-end fund on the New York Stock Exchange.
Certainly. I mean, if you want to keep it in, we can certainly keep it in. I think in talking to the managers and our research group, no one felt a need to keep it in or has used that piece of the guidelines in managing Norwalk's accounts.
I mean, it would be interesting if we ended up buying a liquid closed-end fund infrastructure play. That would really confuse everybody. But
At a discount with a dividend.
with a dividend. Anyways, do you want to just, what do you think? I mean, is it, Jim?
I'm indifferent. Doesn't sound like we've ever used it. I don't care if it stays or goes. Doesn't matter, I don't think. I think it's irrelevant, but
Joe, do you want to just leave it in then?
I mean,
Your call.
leave it in.
then
Britt's going to call Tom up after this meeting and go, oh my God.
What a pain in the ass those guys are. Oh my God. And I gotta go see him in person next month? Are you kidding me? You're going,
No,
Tom, not me.
I enjoy our conversation and discussion. I'll tell you that much.
Okay.
So just another minor edit on 15, and I believe that is it.
okay.
Okay, you know what? I do have a couple of points. Just as on page 16 about credit default swaps. And then another thing is, so there, I think here it talks about the commercial paper. It talks about an average ratings, right? Combined rule, let me see where it is. I guess what I'm trying to ask is, where did I put this? I have all these notes. But if there's some investments that are made and kind of the wording was that there's, an average rating, right? Somewhere, where did I put it? Maybe I'm losing my mind.
I think I just highlighted it for you, Frank.
Yeah, okay, and then, so yeah, the average credit rating, okay? Now, the thing about that is, could that have, say, CCC paper, but it's averaged out because it's got AAA paper? And so should there be not only like an average weighting credit quality, but a minimum credit quality? See what I'm saying? Because like say you had half your portfolio in AAA and could you have half your portfolio in CCC? So, I mean, would be highly unlikely, but I would think we should have.
Prior page, yeah, let's see.
I think we should.
You want to put a minimum. You want to put a minimum rating on there, Frank.
Yes.
Okay.
Well, before we jump into that, the way it's written here is the way our managers have been managing our money for a long time, right? In the fixed income world.
Correct.
Yeah,
I think the one caveat here is that you don't have any separate accounts within your fixed income managers. So they are not
So it doesn't.
obligated to manage the portfolios to these guidelines. You're
Okay.
in the commingled funds, which have their own set of manager guidelines.
Okay.
It's a moot point.
All right. So we're not going to rock the boat by making a change here. In other words. Got it.
Exactly.
Go for it, Frank.
no, I mean, whatever, what would be triple B or, you know what I'm saying, or double B? What do you think, Britt? I mean, do you think, maybe it sounds silly, but I just don't want to find out that we ended up having, that we ended up having some high risk paper, but it still didn't violate the average.
What's the lowest
Yeah.
investment grade rating there is for a bond?
Well, I
What's
think what
the
you,
lowest?
What's
Well, I
the
think, what
lowest
is it?
for an investment grade? What's an investment grade bond? What's the lowest rating for investment grade?
double B minus, I believe.
Okay.
I think the one, by putting in a specific rating in here, if a future board wanted to invest in a
Junk bond.
a more esoteric, riskier fixed income portfolio,
They're not
when
the
you're,
cheap investment bond.
Then they can change the IPS.
yeah. I think in terms of limitations, the idea here is to be relative to the benchmark and not get specific in terms of, specific ratings. But
And I think the point is, if somebody had a junk bond in their portfolio, they'd have to have a lot of good quality stuff to meet the limitations under number one there. Because it's going to have to all weight out. That's it's a par weighted, I guess, thing.
Pretty high quality portfolio.
Yeah, I mean, if they got a junky security in there, it's going to have to be offset by an awful lot of good stuff.
Yeah.
I don't know.
All right, so you want to just leave it?
Yeah, I think it's fine.
Yeah.
Okay. That's the only other one I had.
Okay.
Okay. So you have no other changes, so we could actually vote to accept this. Is there a motion to accept the new IPS?
I'll make a motion to accept the investment policy guidelines as presented.
I second.
Joe,
I second.
all in favor?
Aye.
Opposed? No. Excellent.
Good job, Britt. Thank you.
great. I'll make these updates tomorrow and I'll send the board the final approved IPS for everyone to review.
Perfect. Okay. Just before we adjourn, as I said earlier, if City Hall is open, it may be, it may not be. The grapevine, which Chitsame might know more about than me, is that it could be opening by the end of, someone did give me a specific date, but I'm not going to repeat that, but it would be before May 1st. I know I've had both shots and I've had them for a couple of weeks. I don't know whether that would make a difference. And I think,
Right. More important than that, are they going to bring supper in for us?
well, in fact, what I was thinking is I agree with that, but the other thing I think you should be asking Chitsame is, since we haven't spent any money for these dinners for a long time, that perhaps we could bring in a chef. I mean, just as a thought, so we could send ahead in what we wanted, chicken, fish, or steak, and then go move from there.
So along with the agenda, we'll get a menu.
I think that sounds like a great plan. But,
I'd be fine going to the City Hall.
So would I.
I'm vaccinated.
all right, so there's a
Yeah,
possibility.
Frank, my one,
What about you? Yeah, Brett.
We still have a blanket no travel policy. I don't have any update on that. So at this point, I probably cannot attend in person. That's obviously a fluid situation, but just wanted to be the Debbie Downer here.
I think he's,
Well, then we could talk
this
about it.
meeting went.
Yeah, I'm okay either
Hey,
way.
how do you feel about that?
I think these Zoom calls work fine. I'm okay doing this. I'm okay going to
Right.
City Hall.
Whatever works, Frank, whatever you decide, you make the call.
All right, good enough. Okay,
Well, Frank, maybe you want to pull the board members with an email or something and see what they think.
yeah, I'm gonna do that. I'm gonna first find out when the city, if the city hall is gonna be reopened, and if so, when, and also whether meetings are being held at City Hall.
Frank, we can have a hybrid meeting.
If there's no other discussion or questions or anything else anybody would like to discuss,
Move
if
to
there was a
adjourn.
motion for adjournment,
Move to adjourn.
I'll second that.
all in favor? Aye.
Aye.
Opposed? No. Meeting's adjourned. Next, defined contribution. I'm going to call the meeting to order and seek approval of the minutes from December 9th.
I'll make a motion to approve the minutes.
Is there a second?
A second.
Second. All in favor? Aye.
Aye.
Opposed? No. Motion is passed. Is there any public comment? If there's no public comment, we'll move on to performance. So that, Britt, if you'd like to discuss performance?
Sure, Frank. So we'll walk you through the performance report as of December 31st, 2020. As the DC meetings are quarterly, so we haven't met since the end of the fourth quarter. Total assets in the 401A up to about 8.5 million. You can see about 440,000 of net new investment and about 820,000 in investment returns. I would highlight that the target date funds, which are the default investment for the 401A, have the majority of the assets at about 91.6%.
Britt, could we just, when we get these numbers, could we get the number of participants? Just start
Chitsame, do you have that information? We do not have that information, or maybe Jerry can get it.
Yeah, I
From
can get
Empower.
that information.
Okay, that'd be great.
Okay, thank you.
So, just like to highlight this chart at the bottom, change in fund values, which really takes into account the markets, contributions or withdrawals, as well as transfers in between funds. And as you would expect, with the majority of the assets being in target date funds, they grew the most over the quarter at about 1.1 million, followed by some of the passive equity options. Here we show contributions on the right. You can see a little less than the current allocation going into the target date funds, but the passive funds and the target date funds are and as well as the active equity options are by far the majority of the contributions. And just like to highlight this bottom chart here, where you can see quarter to quarter how participants are allocating their contributions. And so at the start of 2020, that's really when the plan went live with Empower. And you can see over the last couple of quarters, there have been some small deviations from the target date funds. If you recall, everyone was defaulted into the target date funds when the plan moved to Empower. So just like to highlight it, nothing, no concerns or anything like that, but an interesting tidbit to keep an eye on as we gain more quarters of historical contributions. Onto the 457 plan, you can see this more mature plan, total assets about 43.2 million. About $1 million was withdrawn and about 3.8 million in investment returns. Again, like the 401A, the target date funds were the default when the plan was moved to Empower, and you can see about 72.5% currently in the target date funds.
I was going to ask, is that, I did circle that about the $1 million of net new investments, the negative $1 million. Is that common or is that unusual or?
In these types of plans, so typically 457 plans have been around for a long time, and they're a voluntary savings plan. So the 401A is really a plan where you're not going into the pension, and that's their primary savings vehicle. The 457, on the other hand, tends to be a lot of older employees who have access to the pension, and this is really a voluntary program. So seeing $1 million come out is not surprising, because I would assume that some of these participants are either retired or retiring and are taking their funds with them.
Thank you.
So here, just highlighting the asset allocation, again, target date funds, the majority, followed by the passive options and the active equity options. And you can see 7% allocated to stable value. And again, that's a higher uptick in stable value in 457 plans is pretty typical, given that this is really a voluntary savings plan, and a lot of these participants are very conservative with this extra savings in addition to the pension plan. Just highlight this chart again, change in fund values, and as you would expect, the three most popular categories, the target date funds, the passive options, and the active equity options received the most during the quarter. And again, similar to the 401A, on the right pie chart, you can see where the contributions are going. And down at the bottom, you can see historically the allocation of contributions from participants. In terms of performance, you can see the American funds, target date funds performance over the quarter, strong absolute performance, around 5.95% to about 13.5%. All the funds outperformed their benchmark. Would note that most of them trailed the Cowen median peer, which is this third line under the Cowen target date under each category. That's the median peer target date fund. And the underperformance is really being driven by an underallocation to small and SMID within US equity and a little bit of a cash drag. So in the fourth quarter, small caps rebounded significantly, and American funds tends to have more of an overweight in large cap US equity. So it's really a relative underperformer there, but no concerns. And you can see over the trailing year, really strong performance across the board, with returns ranging from about 9.2% to 19.4%.
Do we have participants in the 2010 target fund? I thought we did this for like 7 years with the 401A, and that was 11 years ago. What am I missing?
So it will roll off. What we can do is, typically the way these target date funds work is a 2065 fund will be added and the 2010 fund will roll off.
I'm just wondering how people got, when did we first start investing in these funds? When the 401A was set up, which was?
No, when the plan went to Empower. So when the record keeper conversion changed, that's when this was added to the fund lineup.
Which was in 2018 or 19 or whatever?
No, it was just the beginning of last year.
Okay, so who was putting money in a 2010 target date fund last year?
The older population. So if the participants did not elect where their funds were to go, they were defaulted into the appropriate age-based target date fund. So the older side of that population.
Okay, so if somebody was 70 years old.
Exactly.
All right, that makes sense. Got it.
I mean,
Exactly.
How's that possible?
Well, somebody based on a 62 or 65 retirement, and if you were 70 years old when we started the fund, they'd backdate it to 2010.
I mean, there's actually a target date fund 2010.
So that should be rolling off. So I'm actually going to follow up with Capital Group to see when that will roll off and when the new 2065 fund will be added.
How about
Don't
20?
forget, we had some retirees that were like 90 years old, right? So if that's assuming a 2010 retirement for a 65-year-old,
You're going backwards.
yeah.
Okay.
And will they
Yeah.
just roll all this money into the 2015?
2015, it should be in 2025.
2020.
I mean, yeah,
Yeah.
I mean, and that's what that's why I'm asking,
That's typically the case. I'll confirm with Capital Group because I'm surprised, that you mentioned it, the 2010 fund. I'm surprised it hasn't rolled off yet. So I'll confirm where it rolls into and when the new 2065 fund will be added to the lineup.
Okay.
So in terms of the individual investment options, you see here we have the passive funds. So you have the large cap, the mid cap, international, and the US bond. All of these passive funds continue to track their indices well and have performed within expectations. Within the active equity options, you can see that the JP Morgan Equity Income Fund underperformed the Russell 1000 Value Index for the quarter, but has performed very well over the trailing year. And most of that underperformance is stock selection within the consumer discretionary sector. In particular, one name that underperformed in the fourth quarter, Best Buy, but they maintain conviction. And, this is a really high conviction, large cap strategy where they are going to take bets on certain stocks, but no concerns overall. Their long-term performance continues to be very strong. The MFS Large Cap Growth Fund, you can see they outperformed for the quarter, but have significantly underperformed for the trailing year. This is really, they classify themselves as a conservative growth fund, similar to our conversations in the previous meeting about Artisan. They really do take quality into account. And when Tesla, Amazon, and every 5 names are driving the stock market over the last 1 and 3 years, a lot of those names are either going to be significantly underweight to or not owned. So just wanted to highlight that. GW&K underperformed for the quarter, but outperformed pretty significantly for the 1 year. And most of that is, again, a quality bias in the fourth quarter when stocks went straight up, as well as a little small allocation of cash, which dragged on performance. And then finally, MFS International Fund, underperformed for the quarter, but significantly outperformed for the year. And most of that was an underweight to financials, and financials in the fourth quarter did significantly better than many of the other sectors within the ACWI US index. Within fixed income, the MetWest Total Return Fund continues to be strong. That's the same fund in the pension. And you can see over both the quarter and 1 year period, strong outperformance there. And finally, the Invesco Stable Value Fund has done very well. You can see outperforming both the median peer and Callan's index, as well as the benchmark of the 3-month Treasury bill. So overall, no concerns. I would highlight that most of the active equity options that were selected for this plan are exactly that. They're active and they will make stock bets. And I think a lot of that deviation versus the benchmarks is reflected in that, but no concerns. Any questions on performance?
Nope.
Thanks,
Nope.
Brett.
Thank you. Move on to
IPS.
the IPS.
All right. So I did want to highlight that Ray, if you recall, the last time we brought up the IPS was around the time of the record keeper conversion, and Ray wanted to circulate this with the players that be within the city, as well as the city's legal counsel. And Ray got the green light and said there were no issues. So I did want to highlight that. Overall, this is really kind of our base case IPS. We're really starting from scratch here. So we take into account, one, we describe the plans that cover both the 457 and 401A. We want to define the board's role as well as all of the staff and third parties, including myself and Callan's role. Describe the structure philosophy, and similar to the pension IPS, really detailing all of the various procedures that need to take place in managing the defined contribution plans. I wasn't planning to go through it all. I'm happy to walk you through it, but I'll kind of open it up to questions or comments.
Yeah, I don't think you have to walk through the whole thing, but I did have a couple of comments myself. Only just, when the beginning of the background purpose and you use ERISA, it would just be maybe helpful because the one for the pension board, you state what ERISA is, what it stands for, right? Employee Retirement Security Act, just so people would know that. And then the only other question I had
Sure.
was whether something in there says that the defined contribution committee does not make direct investments or provide advice to participants. Somewhere, I don't know whether anybody, I just wanted to clarify that we don't, whatever people do with their money is their decision. And we don't give advice. Empowers giving advice to them perhaps, but we don't as a committee, because we do it, we make investments in the other plan, obviously, and so that would be the only thing that I would perhaps like to see added, but if you don't feel that it's a necessity, that's fine too.
You want a negative in there. the committee is not responsible for making recommendations is what you're looking for, Frank.
Right, we do not make the investments, and also that we don't provide advice to participants.
Hey, Britt, could you unshare your screen for a second? I had some notes and I put them in the PDF. Thanks.
Getting fancy here, Jim, huh?
Yeah, I can't. I didn't print it out. I'm sorry. Let's see what I had.
Hey, Britt, have you heard of what Frank is asking for in a DC plan, a negative on what we're not responsible for? Or is there a need for that? Or have you seen that before in a DC IPS?
I have not. I think, in terms of laying out the responsibilities, I think it's pretty encompassing and it does not include that. I don't see any reason why, if you specifically wanted to state something under the DC committee as I don't see any reason you couldn't. I haven't seen any clients specifically do that in the past, but if that would make you feel more comfortable, you can certainly add it.
Is there anything in there that says that the plan participant, what they're responsible for?
You can put your screen back, Britt, if you want. I looked at my document. Go ahead. If you want, yeah, there you go.
No, so we don't describe the role of the participant. It's really specific to managing the plan. And, the participant is a completely separate party that will utilize the plan. But in terms of the IPS, we're really defining the roles of the committee, the city staff, the record keeper, and Callan, and as well as the investment managers. And that's typically what we see in terms of the roles and responsibilities. I think, by aspiring to ERISA, it's understood, that the committee and these parties do not have any involvement in what the participant chooses. But
I'm just wondering, from Frank's point of view, if an employee had an issue with something that might have happened with investments, if there was something stated in this IPS that squarely put the investment decisions on their shoulders. Frank's point. Whether we say we don't do it, or we say it's up to the plan participant to make their investment decisions. I'm just thinking,
We're still in it because it says right here, we identify the options and we monitor results. So we can't separate ourselves from this completely.
No. We're trying to separate ourselves from making the investment, decisions.
Right, I'm saying we don't make direct investment decisions or provide advice to participants.
It's the participant's responsibility to do their own
Right.
allocation and their own investment decisions, period.
And that would just be the responsibilities of the DC committee. It would just state what the responsibility, what we are not responsible for.
We can either do that or put them in there what they are responsible for. I mean, one or the other.
Well, we have the responsibilities listed. I think what you're saying, Frank, is to have a paragraph at the end of a sentence at the end of these bullet points here that says the DC committee is not responsible for
Right,
making investment decisions for a particular participant,
right.
Or ask it out, right.
Or
And
providing.
we could add that right here after this sentence. Or we could add it down here. I mean, I'm happy to. I don't think there's any reason why you couldn't.
Yeah.
Yeah.
However you think we put it in, is that okay with you guys?
I think it's a smart thing. I think it's a smart thing to put in there.
So the DC committee is not responsible for any participant investment decisions or participant investment advice.
Yeah,
Well, the advice part is a little gray because you hire the record keeper, which is in charge of participant advice. That would be my only comment on the advice part, but
well, we don't provide direct advice to participants.
Yeah, I don't know. It's going to be tricky to find the right words here.
Well, I mean, at least there might be not be the perfect words, but if there is a problem, I'd rather have some words there.
Yeah, I hear you.
so what about the DC committee is not responsible for participant investment decisions?
Perfect.
Perfect.
Yeah, that works.
Great. We will add that.
I don't know if we have to go through the rest of it. Is anybody, Jim, you had some notes. Did you have any questions?
They were on the other document and we covered them all.
I
So
think
I'm
it's-
happy to do the whole
we
thing
need
up
to
there.
go through it all.
So do you want us to, because we'd have to wait 3 more months, should we have a motion to accept this and with that singular change? Would that be probably the best plan? So if somebody wants to propose that we accept the, this investment policy statement?
All right, I'll move that we accept the investment policy statement as presented with the exception of adding a sentence that delineates what the DC committee is not responsible for.
And is there a second to that, Joe? All in favor?
Aye.
Aye. Opposed? No. Excellent. And if there's no other discussions, there's a motion for adjournment.
Oh,
Oops, somebody else. Hello.
I'm sorry. I just went on our Empower website and I know you wanted to know how many participants we have in the 2 plans. We have about 462 participants in the 457 plan and about 340 in the 401A plan.
Perfect.
Excellent. May, thank you very much. As always, every time I ask for anything, you're right on it and you do it. And I appreciate that very much. So there was a motion, I believe, Joe, for,
Motion to adjourn.
I'll second that.
a second. All in favor?
Aye.
Okay, hopefully we'll see everybody next week at City Hall eating sandwiches and
month.
Joe will be there to complain that I ran over 8 till beyond 8 o'clock
Next month, Frank, next month.
next month. Excellent.
Okay, good
Thank you
enough.
very much.
Thanks, everyone.
All
Good
right,
night, everybody. Thanks, Brett, for
Thank
your
you.
patience.
Thank you.
thank you.